Okay, it looks like we're live. I don't think we have any indication of people joining, but I assume people are joining right now. So for those who have joined us, we'll wait another minute or two to kick this off. Feel free to join the chat and let us know where you're joining us from. Okay, we'll begin in exactly 1 minute. Oh, cool. Yeah, I see we have some folks, someone from Mongolia and Brazil. Glad to have everybody on. Okay, let's kick this off. This is a session that I'm really excited about doing. Wanted to do this event for a while. We have some fantastic speakers here today, and we're going to be talking about a really important topic. So many vertical SaaS companies start with an initial product, a product that solves a big enough pain point for a group of customers. But then over time, it becomes harder to acquire new customers. And one of the ways to continue and grow is to add more products into the platform. We have with us today some amazing leaders from vertical SaaS companies that have gone through this journey and have built really successful companies. And this is what we're going to be talking about today. My name is Itai Sedan. I'm the CEO and co-founder of Duda. And we have been a partner and a vendor to many of the SaaS companies out there who have gone through this journey of going multi-product. And our product, a website builder for digital marketing and agencies, has served them with a way to continue and grow and expand their revenue. So my point of view is going to be as a partner on the other side of the table to many of these great leaders that we have here. I'll start with introducing our panel today. We have here Andrew Walsh, partner at Tidemark. Prior to joining Tidemark, Andrew started his investing career at Bessemer Venture Partners, a venture capital firm where he was focused on early stage investment in enterprise software and consumer internet. Andrew was a board observer at Toast, Disco, Entoggle, and many other great SaaS companies. Part of what we'll be talking today with Andrew about is the Vertical SaaS Knowledge Project, which is a really interesting project that Tidemark has worked on, and you can find that on their website. And that project encapsulates a lot of their experience and learnings from working with many different vertical SaaS companies in the industry. We also have Irshad Jamil. Irshad was the former head of global business development and innovation at Cloud Kitchens. He was also the former chief growth officer at Service Titan. While at Service Titan, Irshad built multiple product lines that contribute today to millions of dollars of ARR. Things like credit cards, checks, customer business financing, payroll, payables, email automation, and the list goes on and on. So Irshad definitely has a ton of experience on launching different products. We'll talk about that. And then lastly, we have Jason Richards, who is the Vice President of Strategy and Corporate Development at Cloudbeds, the hospitality management platform powering reservations for lodging businesses around the globe. Jason has led 3 successful acquisitions and has been instrumental in developing Cloudbeds' global go-to-market engine. So thank you guys for joining us on this panel.
Thanks for having us.
Pleasure. Great to be here.
Awesome. So let's kick this off with Andrew. Andrew, maybe let's kind of lay the ground. And first of all, maybe you can introduce Tidemark. And while you're doing that, explain what is vertical SaaS, just to make sure we're all aligned. And why has Tidemark been investing in vertical SaaS for so long when many VCs historically have shunned away from vertical SaaS because of different misconceptions of maybe a small TAM or a niche market, fragmented SMB space, etc.
Yeah, happy to. Appreciate the softball questions to kick things off here. So Tidemark, we're a growth equity firm. We launched about 2.5 years ago. We manage about $600 million of capital, invest checks anywhere from 20 to 150 million. And our focus is to invest in the next generation of category leaders. So we're not a vertical SaaS only fund. It's where I spend the majority of my time. But we invest in all areas of software, consumer marketplaces, you name it. But on the vertical side, we've been really lucky to invest in over a dozen great businesses within SMB and vertical SaaS that have gone on to build dominant platforms in their respective end markets. So think ServiceTitan, CCC, Carbon, Toast, SiteMinder, just to name a few. And we're really laser focused on continuing to back those future leaders. One other note I'd call out for Tidemark, we have a amazing group of Tidemark fellows. Actually, Irshad is one of them. They're a huge part of who we are as a firm. And then another big portion is we're not an impact fund, but we have an impact component. So giving back is a big part of what we do. And so we have the Tidemark 10 Foundation. So 10% of our profits go to that foundation. To set the stage a little bit, vertical software built for industry, built to the specific needs of kind of the owner operators within a given market. And the world really hated SMB and industry software 10, 20 years ago. The markets are too small, they're too fragmented, the small ACVs can't support traditional go-to-market. So that's what people would say. I think what we saw early on within vertical software is that these small business platforms can be incredibly valuable. That owner operator, they have incredibly busy schedules, and they really want that one vendor to deal with. That single point of accountability to solve all their needs with a tool that's actually built for them and their industry and speaks their language. And a result of that is these tools can go on to build really dominant positions. So get market shares of 40+% versus horizontal players, which can get up to, call it, 20% market share. And you look at a business like Viva is probably closer to 90%, maybe close to 100% of the life sciences industry with their core CRM product. So those are some of the things that we saw. And on the fragmentation piece, it's a feature and a bug. I think on the feature side, high fragmentation means SMBs have a shot, and there's higher likelihood of marketplace opportunities, and typically means that there's stronger monetization of payments opportunities as well.
Awesome. So Andrew, you guys, as I mentioned earlier, encapsulated a lot of those learnings of over a decade of investing in vertical SaaS into this vertical SaaS knowledge project, VSKP, we'll refer to it. Can you explain what was kind of the thinking behind putting this project together? And in the VSKP, I think there was while reading it, I felt like a really interesting point was the control point. So maybe you can explain also what is a control point and why is it important when you start a vertical SaaS company to start from one of these control points?
Yeah, of course. So, we've seen, 9 companies scale to north of 100 million of ARR on the vertical side. 5 of those have gone to surpass the 500 million ARR mark. And I think along the way, there are a lot of learnings to be had. So we wanted to put our heads together and develop a framework in the form of the Vertical SaaS Knowledge Project to combine our collective learnings and build case studies to share those with kind of the future generation of vertical SaaS businesses. And really what it does is it highlights how to win your category by establishing that control point, expand your offerings, which is what we're talking a lot about today in terms of going multi-product, and then extending through the value chain. So addressing the other stakeholders, whether it be suppliers, your consumers, or your employees. And that's really what the Vertical SaaS Knowledge Project set out to do. A really core part of the Vertical SaaS Knowledge Project is this concept of a control point. And I think the simple way to think about it is it's the last software a customer turns off before shutting down for the day. Or if you were to wind down your business, what's the last piece of software you'd want to get rid of? Chances are your control point if you kind of fall into one of those two buckets. Typically, there's one in the front office, so it touches the customer, like a point of sale or a CRM, and one in the back office, so something touches the general ledger. And we talk about them in terms of types of gravity. So there's workflow gravity. So do you manage the scarce assets of data gravity? So do you hold the most critical information for your customer to run their business? And oftentimes this data can be used to enrich the customer workflow experience as well. So these are all interrelated concepts. Account gravity. So are you solving the needs of the most important user or sponsor of the tool? Those are probably the most traditional ones, but there are other control points that are kind of newer, maybe look a little bit different than a traditional system of record. So these could be things like business model innovations that can drive incremental demand. So think channel managers, or buy now, pay later solutions, things that can enhance consumer experience, like embedded fintech, being able to offer more efficient and better lending to your customers, or an integrate and surround approach where you tap into a legacy system, enhance it, and over time kind of subsume it over time.
Awesome. Yeah, I found this again, the Knowledge Project, really super interesting, and we had here at Duda like the entire management go through it, and we set like 2 hours to go and discuss where are we on this journey, and I really recommend for anyone on this call, go to Tidemark's website, Vertical SaaS Knowledge Project, and I'm sure you'll find this interesting. So let's move on kind of to Jason here, and hear kind of more of a practical experience. Jason, so Cloudbeds, tell us a little bit, where did you start? What was that first product that you launched with, and how did you go about thinking of, when is it time to launch kind of additional products?
Yeah, sure. Happy to. So, I mean, we're into our 11th year now. And for those who don't know, we're a hospitality platform that lodging businesses use to run much of their daily needs. We started off 10 years ago, or almost 11 now, as a booking engine. And it really began with this idea that hospitality has always been, and still is today, somewhat of a laggard in the technology adoption space. It's probably right up there with government and healthcare in terms of the way industry has adopted technology. But that was very apparent back in 2012, and our founders, Adam and Richard, were they were avid travelers themselves, and identified the difficulty that existed in trying to book any hotel online through the internet that wasn't a Marriott or a Hilton or one of the big chains, and realized that there was, these larger, the gorillas in the zoo had access to technology that just wasn't available in the SMB space, which in hospitality is about 87% of every property on the planet is actually a small independent hotel or other type of lodging business. So the booking engine really was the first opportunity to give these SMB hospitality businesses the opportunity to win some business from the larger from the gorillas in the zoo and do better themselves. And that very quickly, translated into a realization that the clear next step in the journey, I think Andrew just referred to is that control point in the business. For us, it was what's known as the PMS, the property management system. And that's where a hotelier will manage all their reservations, check in a guest, check out a guest, run all of their reports for the day, do all of their reconciliation and the like. And that inside of the office plugged into the booking engine on the outside and became the clear next choices, to, in most cases, replace something that the hotelier was already doing in some way or another, whether that be with an Excel spreadsheet or using some legacy technology as mostly existed back then. But either way, it really established Cloudbeds as the central point inside of the SMB business that they used every day, and was probably at that point the PMS became the last thing that was switched off, to use Andrew's terminology at the end of the day. From there, the next most important piece was the distribution piece and the channel management, which is in the hospitality space is what we use to distribute rooms and rates across all of the booking.coms and Expedias and branded websites of the world. So, the next opportunity for us to create value we saw was being able to help our customers, again, do something that they were already doing, but was laborious and time consuming, and giving them the tools to do that better and be better, save time in doing it, was the channel manager. And, for various reasons, the best approach to that at the time was to acquire that piece of technology, which, has been a very foundational piece of our business ever since. From there, we kind of moved into this win the category stage, as you can see from that growth line there. We experienced great growth owning that control point and these three core pillars of the business, and we're able to then look at, okay, so how do we expand our products here into the next likely opportunity to create real value for our customers. And that was what we call PI, which is essentially it's price intelligence engine, which is essentially a price setting tool. And again, that was a situation where, we realized our customers were either not really price setting at all in relation to demand and changes in competitive pricing, or if they were doing it very manually. So we both enabled them to do something that they, in many cases, had never been doing before, or if they had been doing it before, enabled them to do it better than they had been doing it before. That continued on our journey towards expanding more into further product lines, but then deepening into the stack where we looked to payments and websites, and again just became this cycle of what are our customers doing today, or what aren't they doing today that they should be doing that's going to make them better, and how do we fulfill those needs. So over time that's evolved into a product set which on the next slide, if you were to move forward, you'd see really consists of that control point, that core offering, the property management system, and the distribution and booking engine around it, which is how our customers acquire their business. You can think of it that way. The pricing intelligence engine, that price setting piece, the whistle guest experience, which now owns the poles and wires, which is how our customers communicate with their guests, whether it be via email or text message or WhatsApp. The fintech offering, which has streamlined their ability to take payments, consolidate more vendors into our platform, capture more workflow, and make the financial piece easier for them. And now, most recently with Cloudbeds Amplify, we're getting very much into the demand generation side of the business for our customers, and helping them position themselves and market themselves in the places that they need to be seen online. And that journey really has been one of deepening the value that we're creating for our customers across the things that they're already doing to the things that they aren't doing but should be doing. And the exciting thing is we still have a long way to go. So if you move to that next slide there, this is really how we think about it. That we see the reservations and distribution in the middle of our vertical platform as really being the blood that pumps through the veins of our customers. And that really is the control point that we control through the PMS. And around that, we have these three pillars that, we believe that everything that we do in creating value will either delight our customers, the guest, help them increase revenue, and streamline their operations along the way. And as we think about the product categories that we deliver today and will deliver in the future, they really exist around that control point and those three pillars.
Awesome. Super interesting, Jason. And we'll get back to you in a few minutes to kind of understand better how you make the decision of what are the next products that you're going to build. But I want to take the opportunity to move over to Ershad. And Ershad, maybe you can tell us, at ServiceTitan, what was kind of where, we know that ServiceTitan is a super successful company. Where did that journey start? What was the first product? And how did you go about making those decisions of, which product are we next going to introduce into the customer base?
Yeah, absolutely. And thanks for having me, and excited to be here. I think, back in the day, it's been quite a while ago. It was around 2015. And around there in vertical SaaS, a lot of the focus was on, core users, core user pricing. There really wasn't a concept around, add-on products, expansion products. There were a few that were doing it like MindBody with FinTech and a few others, but the concept today, which I think Titanmark with Andrew and Dave and team are doing a phenomenal job putting together a playbook of like, what are these vertical SaaS companies doing today? Because back then it just didn't exist. And so it's really like following your customers. I think, any other B2B SaaS company, you just got to understand how can you create the most value for your customer? And within that, what type of products and offerings can you actually, develop over time? Traditionally, it was, core users, and you may have, package pricing, good, better, best, and you may plug in different products right within each package. But then really the idea is that it's really a share of wallet approach, right? So if your customer is spending money elsewhere and you are the system of record, I think the key is that, right, if you're the system of record, you're in a really great spot to develop really amazing solutions. So instead of, for example, a contractor using 10 different softwares, using a field service management software, but then, using payments, using marketing automation, telecommunications, there's this ability to actually build lightweight products that create actually more value because you can have a better user experience. Those customers can provide a better experience for their end customers. And kind of what this slide is showing is that, following the money of, what your customers are spending money on, what software they're spending money on, how does that tie to your product? How can you create more value to them? That was kind of a key factor in terms of, building out these ancillary or add-on products. A lot of obvious ones today are FinTech products, just because the value that you can create, the more efficiency you can create for your customers, and the monetization piece is pretty awesome too. So back in the day, you kind of had to create your own. You had to partner with a lot of companies behind the scenes because to build your own payment facilitator is quite complicated. Today's world, it's actually pretty awesome. There's companies like Payably that are out there today, which basically are built for vertical SaaS companies, so you can actually get off the ground very quickly on payments. But that was one that, whether it's, Toast or ServiceTitan or MindBody or whatever it may be, they're pretty significant business lines for those companies. So yeah, FinTech was the first one that we got started with back in the day.
Right. And what was what kind of was the evolution from there? How did you make decisions of we're going to build product A or we're going to build product B? What kind of was the decision making behind that?
Yeah, that's a great question. So I think I don't know if I was lucky enough or was in consulting for a long time, but it was 10 years management consulting. So I just love frameworks. That's why I love what Andrew and Dave are doing. The buy, build, partner approach just understanding, right, those opportunities, understanding the, revenue impact, the value to customers, which ones to do next, which ones to experiment with. I think some companies, they try to take on too much all at once, and they may not be ready for it. So getting off the ground, with one, making progress within it, and building out your go-to-market motion, like aligning sales, implementation, success, support, operations. That's a critical part for the success of these products, not just building them, but obviously just going to market. So that was a big component. But essentially, is the value part. So we start off with fintech and move to marketing automation and a few other products. And so again, it comes back to focusing on your customers and what creates most value for them. And then what's pretty remarkable, and part of my thesis is that especially in B2B SaaS, roughly 30 to 50% of your ARR one day could be from these ancillary add-on products. Kind of depends how you package your current pricing along with ancillary, but it could have a meaningful impact. And if you structure the products the right way, it could have a meaningful impact to gross margins as well. Because a lot of these you don't have to build, right? You don't have to become a fintech company. You can partner with a fintech company. You don't have to create your own website company. You can partner with Duda. So that's why there's phenomenal companies that are out there today where you want to be very specific about who you partner with, because you want to make sure that partner also has the same level of service that you provide. I think that's a critical factor where sometimes companies launch a product with a partner, they didn't do the proper diligence with that partner, and they may not align with the values of the company itself. So, for example, when I assessed, on the fintech side, I probably assessed 30 plus companies and landed with probably, 2 to 3 that I wanted to partner with, because you want to align with the right one and then have that as a long-term relationship. Sometimes some companies partner with a payments company, then move to another one, then move to another one and another one. And then you have, 4 partners behind the scenes processing payments, and it gets pretty complex and convoluted. So making sure you do the diligence up front about who you partner with that could power an add-on product is a critical factor as well. Obviously, you should always consider acquisition and all these factors as well.
Yeah, absolutely. Like we see it as well, right? Every company that partners with Duda, it's an extremely strategic decision, right? They're going to white label Duda and offer as one of their products from their customers' perspective. There's no difference between the website product that is powered by us or any of the other products that they're offering. So you need to have a huge amount of trust in that vendor that you're choosing to integrate into your platform. And in most cases, this is the CPO, the VP of product kind of decision, right, to own this type of relationship, as it's so core to the platform.
Yep.
Jason, maybe tell us, right, you guys have done a couple of acquisitions, you've built your own products. How do you decide between build, partner, buy?
Well, when Ershad mentioned frameworks there, I had a little smile. Also a lover of frameworks. I think they really encourage clear and comprehensive thinking. And so, we have a framework we call our platform decision matrix that we use to decide as we identify what might be the next category that is an interesting product for our customer set. As we look at it and we look at the build, buy, partner question, we rank it across various opportunity criteria. One is competitive differentiation. How much competitive differentiation will we get out of this particular product that we're thinking about here? Is this part of our core competency as a business already? To be able to do something like this? How mature is this product or this category in the marketplace? Is it something that's emerging today, or is it something that is, has been around for quite some time, and a lot of the innovation work has already been done in the category? How defensible will it be, and how long will it take to get there, and how does it affect our competitive positioning? And then, of course, things like, what's the capital cost of each particular option is always a big question mark. And then there's the execution or vendor risk with each approach as well. So, we kind of rank across all of those various criteria, and it helps us understand, is this something that we should go and buy? Is time to market important? If we acquire this, does it bring us competitive differentiation quickly? If it's not a core competency of ours that we already have internally, does acquiring it make sense to get that core competency quickly? They're just some examples of how the question fits into the framework. And, depending on whether or not you're looking at a partnership or an organic build, there'll be different answers to each question. And we're able to kind of score and rank that and come out with a conversation at the end of the day that guides us.
Right. So if we take, for example, Duda or websites, what I assume you made clearly the decision there to partner and not do it yourself. Maybe shed some light on like what was the thinking behind that.
Yeah, sure. I mean, first of all, we didn't see, as a hospitality software company, we didn't see CMS and website development as an existing or necessary core competency for us at Cloudbeds. And we could see that there were already, it's a fairly mature category where there is already some leaders and some people doing it very, very well. And it was very unlikely that we were ever going to do it better or different to the Duda or any of Duda's competitors. And therefore, that was probably the driving factor in this is a clear partnership approach for us. And we also saw that there is not a lot of vendor risk as well in this space, because there were a number of good options out there, and we decided that Duda was the better of the good options, and we haven't regretted that decision. Okay,
that's great. Irshad, moving back to you and your love for frameworks. So you have here like this really interesting framework you put together of evaluating which products potentially to launch, their impact, their level of effort. Antonio, if you can put the slides again. This one. Can you explain a little bit the framework of how you kind of navigate between these different opportunities of building different products? I'm sure a lot of the folks here on this call have ideas, and there's different ideas running in the business. How do you assess which is the best idea to actually pursue?
Yeah, it's a great question. It's definitely not an easy exercise to determine the priorities and the impact they make, because a lot of it, as with software, right, you don't exactly know what's going to happen. You just got to do the best diligence up front. But I would say even early in the process, like understanding the workflow of like how your customers use your software, what do you plan to build, and kind of differentiate the core versus add-on. Like what are things that we think is core or foundational for the software? Why would someone sign up for this software? And then once you sign up, attaching these products, which would make sense from a workflow perspective from your customer is the first piece. And then when you decide which ones that potentially are add-ons, this framework generally, helped me pretty well in terms of like, obviously, a lot of the intent is for, generating more revenue for your customer base, expanding ACV. But how does it impact margins? How does it impact net revenue retention? What's the expectation of adoption for these products? A lot of companies obviously focus and break up their customers by SMB, mid-market, enterprise, strategic. Well, every single part of the customer segment attached to that product, it's usually not the case. Usually the case where sometimes an add-on is more geared toward enterprise, sometimes it's more geared toward SMB. Sometimes an add-on can actually really help with retention. If you attach payments to a field service management platform, generally that can actually really help with retention as well. So thinking through the different dimensions is actually an important factor. I think level of effort is a big one too, right? So when you partner with a company, leverage someone's APIs, maybe even some of their front ends, so you don't have to build everything is quite wonderful. So that's a big piece as well. Again, back in the day, 10 years ago, if you want to be, a payments company, you had to build your own payments platform. You could leverage some technologies, but it was quite difficult. Today, it's much easier to get off the ground. So yeah, there's a lot of factors to consider. I think going back to my earlier point, you don't want to do a lot of it all at once. You want to kind of narrow in a few, get it off the ground, build up the momentum, understand the go-to-market team, really educate the R&D team of how they build and launch these products, and then continue to release them over time. And you also can't forget about the core, which is obviously super important. But yeah.
Awesome. Andrew, given kind of the current economic environment, do you see, and right with the importance of focus on profitability, do you see companies in your portfolio playing it safer, doing like less bets, right? There's on launching new products, less acquisitions. What are you seeing currently in your portfolio?
I think in essence, yes. I think it's important to realize that as a company you have limited resources and opportunity costs are very real as you think about going multi-product. You see this big prize of adding embedded fintech and multi-product, increasing your revenue 2, 3, 4, 5 times. But multi-product at the end of the day is really hard. It requires significant investment and it can be really high risk. And there's a really big trade-off too, where if you emphasize going multi-product, sometimes you can de-emphasize your core control point and what made you great in the first place. Where we look at it as this tension between, do you want to drive ARPU or locations, right? And there's a real trade-off there. And so to kind of layer on like when you should be going multi-product, I think you want to do it before you see it show up in the data, right? Your CACs are going to go up, your close times are going to increase, and you want to make sure you get ahead of that. So we always advise the companies that we work with to be really granular about TAM and trying to assess that before you even hit that point, right? Like get down to your ICP, figure out how much headroom you have. And if you have room to run, like it's our general North Star to default to prioritizing locations because you have that unfair right to sell those other solutions later on.
Cool. Yeah. Super important point, right? So what you're basically saying is that if there's an opportunity to like acquire more customers without launching the additional product, either going up market or down market a little bit, or maybe opening new geographies, like that would be your initial recommendation.
I mean, even just hitting the core, not even pushing up or down market, like just driving that land grab, because we see it time and time again that you can get outsized market share.
Right. Because the point is, like, if you have that control point, you can always add you can always add more products later.
Exactly.
Right. So there's less risk. Super cool. Irshad or Jason, any thoughts about, do you feel like in the current environment it's harder to make more bets versus in the past, and like you need to be play it a little bit safer and really make sure that every bet you make on an additional product is really one that is going to work and there's going to be sufficient adoption of that product? Feel free to
I'm happy to go first. I think it's a good question. I think it depends on your risk tolerance, right? So if you build a new product, it could end up being 30% of your ARR one day, and the conviction behind it. I think the idea is that if you can form a single threaded team around product managers, QA, and engineers, and a good GM around a single solution, it could be a small percentage of your overall employee base, but if they can crush a product, right? For example, Ramp has done that. A bunch of other companies have done that as well. And so that could take you to the next level. So it's all about risk tolerance and the diligence you kind of do up front, especially in today's environment. I think to your point, Itay, like you want to be a little more maybe risk averse from the general sense of taking on too much. But if it's something that you think is going to be a winner, taking a bet on that could take your company to the next level. But it is a bet, right? And I think it's also dedication to it's important. If you try to take 20% of a product manager's time and half an engineer's time to build something that you think is going to be significant, generally that doesn't work well. But if you can have a few folks dedicated to it and be fully ingrained and not distracted by other initiatives, that's a big part of success around these products.
Yeah, I think that I think whenever we launch a new product or begin development on a new product, despite the greatest depths of customer research and confidence that goes behind it, it is a capital deployment bet until that monetization is realized. and that cycle of ideation through to actual monetization of the base through the product can take quite some time. So I think that in today's current environment, I mean, there's no doubt that the cost of capital is substantially higher today than it was 2 years ago. And that's causing everyone to think more carefully about those bets and probably want to realize more of those bets paying off before they make new bets. So I think it really just depends on how quickly you can execute on that cycle, how well you can get it right. But I would just caution as well. We think about product investment across the 3 horizon model, and it's important to be thinking about what is going to be that next differentiating product that is going to come to market in 2 years from today, and be dabbling there and be putting a little bit of capital there. That's where ultimately your innovation, competitive differentiation comes from. And despite the environment today and the inclination to monetize, it's I would just caution that it's still important to be looking forward and thinking about what the next game-changing product is in 2 years' time for your customer base. The other thing I would add as well, often it's the customers are or your customer base is a point of resistance too. You can only bring so many products to your customer base in such a period of time. It's a lot for them to take on, and because every time they have to make a buying decision, and for a business, and a buying decision can often be a large decision to make. So that's I guess that's kind of how we think about it.
Great. I want to encourage folks to add questions in the chat. We'll be glad to answer any questions that come up. Until then, so kind of follow-on question: how do you reduce that risk? So there's, as you said, there's ultimately a risk with any new product that you launch that adoption might not be there. Did you find any interesting ways or to think about it of how can we test something out, or how can we make try to evaluate before we put this big teams behind it, and product team, development teams? Is there a way to reduce that risk a little bit?
Real quick for me is that's a beauty about B2B SaaS. If your end customer will talk to you, you basically have all you need, right? In terms of surveys, interviews, webinars, showing them wireframes, talking about the cost of it. Will they actually, adopt this product in the future? And that's what's wonderful about, SaaS in general. If you're high touch with your customer, you can learn a lot upfront. Versus if you build a product and launch it, maybe in some consumer-based product, you kind of just don't know what's going to happen. But a lot of times, if you do enough diligence up front, and it does take some effort to do that, you actually can de-risk something pretty significantly.
Yeah, 100% agree with those. I mean, the magic there is in your customer base. In B2B, you'll always have some highly engaged customers who really do view technology and you as their technology vendor as a source of current and future competitive advantage, and they want to see you doing good and helpful things for them, creating value. Having conversations with them and being able to have real conversations with them is incredibly valuable, alongside the expected customer journey mapping and surveys that we do, understanding the value chain of your customer, where their wallet is being spent, all of that stuff. But when it comes to the actual product development itself, the customer is very much the one holding the keys at the end of the day. So being closely engaged with them, I think, to Ershad's point, highly de-risks the investment.
Mm-hmm. And I think making sure you get input from both business development and product in all those decisions that you end up making, and being really honest about your capabilities and resources. I think points of failure that often happen are when you under-resource against a new product initiative. Allocating, a fractional FTE from a few different departments isn't going to cut it for a lot of these different categories. And so I do think that you want to make sure that if you are going to make the push to go multi-product and launch something new, that you resource it appropriately.
Yeah, that's a super important point. So I assume not every product you guys launched was a success. Anything you can share of, something that didn't work out? What were the learnings behind it? What would you have done differently? Either Irshad, Jason, any of you?
I mean, I'd be happy to say that 100% hit rate so far at this point in time, but yes, I'd be lying. Every now and then we do get it wrong, and I think if I reflect on some of the circumstances where us or we have got it wrong at some point in time, it has always been a moment in time where we've had a little bit too much trust in our own judgment and not enough voice of the customer involved, combined with I can think of one product that we took to market a little more advanced rather than taking a more incremental approach to the product. We felt that because of the value that we believed it would create, and it did create significant value, but it was just a little bit too much for our customer to bite off at that moment in time and get their head around. And we just took too much to them. And subsequently, by taking a few steps back, taking a smaller part of that product to them and having them adopt that, get their head around, derive value from that, we've since been able to continue to grow that product incrementally from that moment forward.
Irshad, any thoughts on the same question?
Yeah, I think, and I totally agree with Jason on this one. One example is that you could build an amazing product, but then if you don't implement that product and get customers on that's, the product may not be successful. So having the right team that can upsell and implement and support that product is very critical. If some product you launch, which is super beneficial for the customer, but it's very difficult to implement, and if you don't have the right team to do that, whether you leverage your existing implementation team or have a separate team do it, it may not be successful. So some lessons learned on my end is that it's really important to align across all teams very early on: sales, marketing, implementation, success, and support in terms of roles and responsibilities. And having like a GM, run these things is super critical. The product manager could be the GM, maybe the BD person is the partner, but driving the add-on product could be the GM. But you need a point person that can kind of rally across the organization and make sure that everything is covered when you're launching and optimizing that product.
Yeah, absolutely. I can also say from my experience is that when we tried to launch a product, and this is after surveys and customers saying we knew customers were using other products in this area, not from us, and they were open to trying out our product. But I think when the product was further away from the core of what we do, so our core is websites, that's kind of the core DNA. The further, if you think about it as an onion, the further away you go, less customers expect it to come from you. Right. So I'll just throw in, theoretically, like if we were to launch marketing automation or something, or CRM, there's a lot of competitors there and it's further away from websites. But when we launched additional products that were closer to the core of websites, it could be something that lives on a website, things like SEO or accessibility or things around privacy. Those were much higher. We got much higher adoption rates than when trying. So I think you need to grow into it. You need to start from where your DNA is, what your core of your company does really well, and where your customers are expecting you to innovate, and slowly kind of expand. At least this is what I've seen work for us.
We call that compounding gravity, right? It's finding other control points that are enhancing that data or workflow around your core. Right. And you're really looking for areas with compounding benefits, right? Where 1 + 1 = 3, 4, 5. And I think a great example of that is, if you have point of sale, turns out you can take a commodity product like lending and actually enhance it and deliver a much better experience. Similar with scheduling and payroll. Like there are certain products that when stitched together are a step function better than the status quo.
Awesome. Okay, still waiting. If again, just a reminder, if there's any questions from folks, we'd love to have our panel here answer them. Feel free to comment in the chat. So, Andrew, a follow-on question to you. We're seeing, I think, due to services today, over 200 different companies in different verticals, crazy verticals that I never believed that there would be software there. If it's laundromats, dog breeders, obviously there's the traditional, real estate and legal. There's in every vertical, there's at least a $1 billion company, if not a couple that are servicing that vertical. Do you think that there's still an opportunity for billion-dollar companies to be created in different spaces of vertical SMB?
I do. I think obviously there's a flood of venture dollars chasing vertical software. I think a lot of folks have woken up to the fact that as you increase share of wallet and can increase ARPUs, some smaller TAMs become bigger TAMs pretty quickly. But I think at the end of the day, like you don't need to be a billion-dollar company to build a really durable category-leading business. I think what is critical when you think about some of those smaller TAMs is you just need to make sure you finance the business the right way. There are just some categories that may not support a billion-dollar outcome, and that's totally okay. You just got to be mindful of how you capitalize it. And then within some of the larger verticals, there's still a lot of green space. Like many industries have been really slow to turn over legacy technology. I think agriculture, construction, I think is still early innings. GovTech, there are plenty of areas where I think we're just innings 1, 2, or 3, and have a lot more opportunity ahead.
Yeah, I totally agree with Andrew. If I could piggyback on that, just within any construction or the trades in general, like if you think of just that TAM itself, think about a contractor coming to your home, a contractor coming to a building, or if a GC building something like a Procore. In that space itself, it's massive, and I think there's going to be many multi-billion-dollar software companies in this space. For example, think about just roofing in general. There's a company called Job Nimbus. They do residential roofing, phenomenal field service management company. In the commercial service space, say you have, Andrew, in a building, you have a mechanical contractor, the property manager had a mechanical contractor come to that building. This company called BuildOps, they focus on commercial service contractors, and it's pretty early in that space, and the TAM is massive, and these customers need a lot of software to help them grow and be efficient. So even I call it vertical within a vertical, right? You could specialize in a vertical and be extremely successful. And that's what's amazing, right? You're serving these customers where you can specialize and focus and your attention on them and create a lot more benefit than, say, a horizontal company that spread themselves thin across a vertical. So that's why it's so interesting in vertical SaaS, is that even within a vertical itself, there's multiple verticals, and you can have a very successful company.
Absolutely. For example, dentists are different than orthodontists, and almost every vertical, once you start to double click it, there's sub verticals that could be interesting. Cool. I see we have a question here from Hans Knapp. Andrew, maybe this is best answered by you. Building a new SaaS company, would you rely on your own money or immediately go out to investors?
I'm going to give the really unhelpful answer, which is it depends. I think a lot of what we just chatted about in terms of what the size of the opportunity is, how heavily vended the market is, there are a whole host of factors that go into it. Maybe to simplify it a little bit, I think you want to be resourced enough to be able to build a great product and make sure that you're delivering a product that solves the needs of your customers. And to the extent that you need capital to get off the ground, absolutely. But then I think how you finance it thereafter is largely dependent on how big the opportunity that you're ultimately going after is. I mean, you look at Viva. I think Viva, is a 25 billion plus publicly traded business now. I think they burned cumulatively $3 million to get to where they are today, and that was I think their approach to it was raise enough to be able to deliver on a great product, but then focus on efficiency, not necessarily a land grab of customers. Because at the end of the day, even in a market like life sciences, where your customers that matter probably are in the hundreds, just really focus on them and double, triple down on multi-product and sell them more. I think their ACVs across their customers are close to like $2 million, which is really remarkable when you think about a vertical SaaS vendor.
Right. Rashad, what do you think about that question?
Yeah, in general, it's really interesting. I think bootstrapping is always fun, and seeing how far you can go with it. I've seen a lot of companies bootstrap to a certain, maybe a couple million and then get a growth equity. But understanding kind of the customer base, as Andrew is mentioning, and the product fit up front, and the level of effort that it takes to build out that product, I think it's a significant factor, right? Like if you're, entrepreneur, engineer, or you're a business person, your partner's an engineer, you can get a product off the ground pretty quickly nowadays, right? Versus 10 years ago. So testing it out with customers, getting it off the ground without capital, it also puts you in a better position to get capital as well. So I think it's definitely a great question, but I agree with Andrew. It's kind of depends on who you are and the opportunity.
Yeah. Jason, any thoughts?
Yeah, look, I think the most important thing there that Andrew and Ashad touched on already is just being real about what product market fit looks like and how big the market is and what it's going to take to get to a point where you can demonstrate to a future investor that you have achieved product market fit, and now this is a fundable business in order for it to scale and grow if that's what you want to do. I mean, bootstrapping it depends on your situation. Bootstrapping, of course, was always be an ideal scenario to be able to get through product market fit and get to scale without having to take any investment. That is a very, very, very rare circumstance. And, I think whatever your personal situation is, understanding what it takes to get from where you are today to where you need to be able to demonstrate that I have a product here that matters and is creating meaningful value for this vertical, and it's something that is worth taking bigger. However you need to do that, I think you just need to figure that out. And if investment is required, then go get investment.
Right. Absolutely. I think, there's some, I think, first of all, it's good, like bootstrapping, or at least getting the first few customers yourself, get, your own confidence around that the opportunity is really there before taking money from investors. And I think especially in vertical SaaS, right, we're talking about niche markets. Many times, I assume the founders have experience in this niche and have felt the pain themselves. So kind of for the founders and that initial team to go get the first couple of customers and prove it out is a little bit expected. Great. I think we're nearing here the end. Let's see if we have time. Let's see. What is Brendan Quinn's question? You've talked about having a GM. How do you think about P&L responsibility for a multi-product portfolio? Who does that sit with? Oh, great question. Anyone want to take that?
Well, that's a good one, Brendan. It really depends. In my view, I think it's very important to have a GM, or as we refer to them as program directors, who are sitting in the middle, and really they're the champion of the product is how we think about them. To the extent that you give them full P&L responsibility, there's pros and there's cons to doing that. But I think what is important, depending on the situation, is that they do have clear milestones of what success looks like and what that timeline of milestones looks like, so they can drive themselves and the team towards that. And if that means P&L, full P&L responsibility, then that can work for some businesses. We choose to not do that and give them more simple, granular, but well-aligned milestones to work towards.
Cool. I'll take one more question before we need a rollout. Michael is asking here, and Arshad, I'm going to give this one to you because I think you were the one that were talking about fintech and adding payment solutions. What are some recent patterns in fintech add-ons? What's possible now that was harder a few years ago?
Yeah, definitely great question, Michael. Credit cards, checks, ACH. In today's world, there's a lot of other software companies that support vertical SaaS companies. So that's one for sure. Embedded finance, I think Andrew mentioned that. There's a lot of embedded finance companies that are very sophisticated, have great business models as well. So credit cards, checks, and financing is those three are in particular really great for vertical SaaS right now.
Great. Well, this has been super interesting. Unfortunately, we have to end as we're starting the next session. So I want to first thank our panelists here, Arshad, Jason, Andrew. It's been great talking to you guys.
Thanks for having us. Really enjoyed it.
It's a lot of fun.
Okay.
Thanks so much.
Thank you. And as we roll over to the next session, we're going to have James Wilton from Monovate join us and talk about pricing and packaging strategies. So James, without let me introduce you here. You and I had a chance to work with each other quite a bit, but folks here on the call might not know you. James has spent the last 10 years helping fast-growing companies monetize their products. He has deep expertise in areas of pricing strategy across industries and specializes in tech and SaaS pricing and in monetization of new products, innovations, and startup business. James is currently the founder and managing partner of Monovate. Prior to that, he was a senior expert at McKinsey & Company and led the pricing service line called Fuel, McKinsey's practice for servicing fast-growing tech companies. James, thanks for joining us.
Thank you, Itai. Great to be here.
Yeah. So, this is going to be the structure here is going to be a little bit different. You're going to present part of your learnings and thoughts doing pricing and packaging strategies over the years. So I'll just hand it over to you, and you can take it from there.
Fantastic. Well, thank you, Itai. We're very happy to be here to talk about this topic today. It's a topic that's very close to my heart. I mean, really, because I have, as Itai said, I've really dedicated my career the last 10 to 12 years specifically on this area. And it's all about capturing value, right? It's really what I think the pricing strategy is, capturing value. And I think that's particularly important when you have a vertical SaaS product, because you're consciously focusing in on a specific space, constraining yourself. You have the opportunity to create more value for that space than perhaps a more general provider would do. And that makes it doubly important then that you know the techniques to be able to go and actually capture the value that you are creating. So strategic pricing, I think my experience of working in pricing over the years, that everybody is very clear on the fact that strategic pricing is incredibly helpful for boosting EBITDA and boosting your profit margins. We've all heard the power of the 1%, which says that if you raise all these different levers by 1%, pricing is the one that gives you the biggest bang for your buck, because all of that drops down to the bottom line. I think what is probably less well understood is actually how effective pricing strategy is at boosting the top line as well. I mean, we found through our experience at Monovate that startups and growing SaaS companies who focus on changing their pricing strategies frequently can get a 10 to 15% bump on their annual revenue growth rate. So really, if what you're thinking about is valuation and multiples, you're going to get the direct benefit of that, but you're also probably going to get an increase in multiple from simply growing faster as well. There's been a very powerful lever for unlocking that. So that's why I think we would all look at pricing, but let's talk about what pricing is as well. And as I said when we opened this session here, I would think of pricing as about capturing value. That's fundamentally what it is. It's helping you capture your value. So you have your own solution. The idea is that you've produced this value-added product, which is going to deliver a ton of value for your customers, And then the goal of your pricing strategy should be to help you capture a fair portion of value of that value. And I say fair portion here. The word fair is important. It's not that we're trying to capture all of the value. Like, the customer should share in that. They should get a portion too, but you should be getting the portion of that value that you would want to get. And unfortunately, as with many things, doing that is a lot more difficult than it sounds, because it's very easy to leak value throughout the value capture process. I think that's a good way of starting off, just to explain that and to level set here what the challenge is. I would suggest to you that for your product, for any particular customer who's buying it, you are delivering a certain amount of actual value, right? And you may be able to measure that, you may not be able to, but there definitely is that value. It is real and it is there. However, I mean, the first big challenge with strategic pricing is that when it comes to pricing, actual value doesn't actually matter that much. What really does matter is perceived value, which is the amount of value that the customer can see. And it's very common that customers don't see all the value that we create. And that's usually because of messaging, right? Maybe it's that we've thought about the value that we think that they should get from our product and the things that should be important, and we're messaging that rather than the things that they actually want to hear about. So immediately you're restricting that. It might be that we know what kind of value the customers are getting from it, but we haven't been able to quantify it. So we're leaving that up to their imaginations, which may not be accurate. I have actually worked with clients as well who actually don't actually know how the customers get value from their product. They just know they must be getting something, and they're kind of afraid to go and poke at the answer for fear of rocking the boat. But for all these reasons, there's a very good chance that the perceived value the customer is seeing is not that full value. So right out of the gate, you've restricted the amount of value that you could potentially capture from your customers. The next concept we should all be aware of within pricing is willingness to pay. And I'm sure that's something that you all have heard of before. It just literally means what a customer is willing to pay. And there are people who tell you that willingness to pay and perceived value are the same thing. And they're not, right? There is willingness to pay and perceived value are very related. If perceived value goes up, there's a good chance that willingness to pay will go up as well. But willingness to pay is always lower than perceived value. And that's for several different reasons. I'd say, firstly, there is always an ROI expectation in any transaction that we're doing, not just financial, right? I mean, but if you're going to give somebody $10, you're not going to expect that you're going to get $10 back in a year's time. You're going to expect a return on that investment. And that's true with making product purchases as well. Customers are always going to expect to get more value than they would actually explicitly pay for. There are sometimes expectations of fairness. Sometimes I might think the value is there, but I just don't think it's fair that you are charging that much for it, so I won't do it. It's all the psychological aspects of pricing. Comparables are really important. Like, you might be able to quite happily sell your product for $1,000 a month for a long time while you're the only product in town. But then if another product comes along in your space and they're, say, charging $200 for their product per month, even if they have got significantly less value than you, the mere fact that they're there is going to affect how much people are going to pay for your product, because them being there is going to change at least potentially change the fair trade of price to value within your market. And budget affects it as well. We sometimes think that budget shouldn't affect it. We think that if the value is there, people should pay for it. But in the real world, there are constraints around how you have to use capital and your operating expenses. Some things are more critical paths than others. So just because somebody believes that something is worth it doesn't mean that they'll actually be able to free up the cash to be able to buy it. And that's going to bring down the willingness to pay. So again, willingness to pay is less than perceived value. So we've lost a little bit more value. With pricing, our goal, if we're doing value-based pricing, would be to set a target price to that willingness to pay for our customers. But that's quite difficult as well, because we don't know what the willingness to pay of all of our customers are. They don't necessarily want us to know that. They would rather that we underestimated their willingness to pay, so we priced lower and they ended up getting a better deal. And also, it's not the case that within your markets that you're serving that all your customers have exactly the same willingness to pay. For buying the same product, many of them may have something completely different. So if you were going to set a price for each one of your customers at their willingness to pay, you would have to have a system that allows you to charge differently across all those customers based on their willingness to pay. Practically, that is incredibly difficult to do. There are some markets where you can do that, but it is very time consuming, it's very cumbersome. And so most of the time we're not charging for unique customers, we're charging at segments. And so for all the segments, all the customers within the segment you're actually selling to, the price you end up charging is going to be lower than the average willingness to pay for that segment. So again, we lose value there. And then we don't even get that in the final sale, because usually with our products, there is some form of sales motion. Where there's a sales motion, there is a negotiation, and there will probably be discounting. And some of that target price is probably going to get discounted away before we get to the final transaction. So the image I'd want to leave you here with is that within this space, we generally create a huge amount of value for our customers, and we end up just capturing a relatively small amount of it because it is so easy to leak value across all of this. And really the goal of pricing strategy should be to plug all those leaks as much as possible and raise that amount of value that you can capture. And I think in terms of ways to do that, honestly, we could talk for several hours about it, but we don't have several hours. We have one, or what's remaining of one. So rather than go through everything, what I'd like to talk with you is 3 specific topics that I think can be really helpful in capturing more value. The first one is price structure. So thinking about how you can use your packaging and your price metric to help you price differentiate and capture more value from your customer base. Second one is price levels here. So how do you set the right price levels, and how do you get the information to help you set them? And then finally, price execution. So this is really how do you prevent unwanted discounting and stop yourself leaking all of that value that you've created, having got to a good overall pricing strategy. All right, well, let's dip into these one by one then. Let's go into the price structure. So there's a concept that we should tee up right off the bat here, which is price differentiation. And I don't think it's an exaggeration to say that this is probably the most important single concept in all the pricing strategy. And price differentiation is exactly what it sounds like. It's setting different prices for different customers based on their willingness to pay. It sometimes gets called price discrimination. I tend to not use that word because discrimination, the word, has a negative connotation, and sometimes people think that you can't price discriminate. You absolutely can. Most of the time, there are protected criteria and groups when you can't do it, but for most of the reasons why any ethical SaaS company would want to do it, you absolutely can price differentiate, and should, in fact. So yeah, so it means charging different prices to different customers. And if you can do that, it has massive benefits for you, because firstly, it means you can widen your TAM. At the moment, if you're pricing, say, with one price point, you're only going to be able to get all of the customers whose willingness to pay is higher than that price point. But there may be price points you could charge which would still be profitable for you and would be above the willingness to pay of some other customers. So if you can do that, you can profitably add extra customers, which allow you to increase your TAM without decreasing the amount of revenue and profit that you're getting from the other customers that you're currently serving. Also, if you can price differentiate as well, you can charge more to your customers who are less price sensitive, and that means you get extra revenue, extra profit from those customers who can potentially pay more. And this can have a massive impact in your EBITDA and revenue. There's an absolute ton of case studies that show companies who've done this successfully, but I think probably the most clear one I can say is that case study from my own past. There was a subscription box company who just had one offering. You can buy the box or you can not buy it. They decided to add a premium tier to this, and they ended up increasing their recurring revenue through 30% through doing that, just through adding a premium tier, because they can now start charging more to those customers who can pay more. Now, of course, it's not just as easy as like, let's just charge different prices to different customers. You usually need a structure to do that. So I think now let's switch and talk about what is the way that we can do that and make those different pricing levels work. The way that you do that is through what we call your price structure. And there are 2 components that we're going to talk through today. The first one is packaging, which again, I'm sure you all have heard of. Packaging just basically means I'm going to create different options or different variants of my product with different levels of value, and I'm going to charge different prices for them and allow customers to self-select which package they purchase. That's called second degree price differentiation. The other way we're going to talk about as well, the other component, and you can use these 2 together, is price metrics. And this basically means I'm going to set my price based on a specific scalable quantity. So if you need more of this particular quantity, or you have more of them in some cases, you will end up paying more. Of course, the obvious example here, is evidenced by the graphic here, is seats. That's the classic SaaS metric, but it is far from the only one, and we'll talk a little bit about that as we get into this presentation. But let's start with packaging. Now, there are many different styles of packaging. I think there's you could have a whole conversation about that. It's probably for another day, but there's lots of different ways that you can potentially package your products. I think the most ubiquitous one within the SaaS space, for good reason, is good, better, best. I'm sure that's, again, a term that you guys have all come across. It is very, very common. You see it a lot. And that's because it is simple. It's very straightforward. Everybody can understand the good, better, best. It's also quite simple to design for companies if they haven't got a lot of experience with pricing strategies and building different packages. And it also has benefits that align with the objectives of a lot of smaller growing companies, right? Which is to be able to acquire new customers quickly, which you can do through having a low price entry version, and then also simple choices that help you weigh up a few options and make you feel better about making a choice. But then it also has a very clear upsell path to take you up to higher price levels as well. So if you are a company that has this land and expand type objective, a good, better, best designed well can really, really help with that. So the benefits are clear. That said, it's not as simple as saying, let's now just create three packages randomly and we'll start doing this and we'll end up getting a good result from that. You still do have to put thought into what those good, better, and best packages look like, and make sure that it all the dynamics around that work for you and make it effective. And through working in this space for quite a long time now, around about 10 to 12 years, I see 4 pitfalls that companies frequently fall into when they're trying to build a good, better, best pricing strategy. The first one here is too much base, and this, honestly, without pointing fingers and obviously generalizing quite seriously, this often happens if the product function is owning pricing. Product leaders tend to be very passionate about their products, and rightfully so. But what often comes with that is a concern about taking features away from customers. They have trouble sort of living with the idea of any of their customers not having all of the features that make their product special. So the result of that can be that there's too much value in that base package. And what that means then is that base package becomes incredibly compelling for the price point, and therefore how compelling moving up to the better version decreases considerably. So you end up with a lot more customers than you would like on your entry version, and you have the land part figured out, but you struggle with the expand part. So obviously, fix there is sometimes you have to be a little bit ruthless and take things out of the base, really just solve for the minimum viable product that your most price sensitive customers are going to be happy with, no more than that. The second one here is called pitching to the middle. One of the benefits of good, better, best, or actually more than the benefits, one of the features of good, better, best, I should say, is that a lot of the times you end up with a large portion of your customers purchasing the middle package. And it is partially a benefit, right? Because when you're evaluating the different options, if there's a middle version, a customer who's unsure about what they want can say, well, I don't want to buy the cheapest one, and I probably don't want everything, so the middle version is probably right. We call that Goldilocks pricing a lot, right? Because it's not too big, it's not too small, it's just right. But there's a real difference between accepting that will probably happen and forcing it or encouraging that to happen. And you sometimes see SaaS companies basically play around with price levels of the different versions to make the value proposition for the middle version way more attractive than either of the other two. So you end up with a lot of customers in that middle version, but then you get a lot of customers who perhaps would have bought the base if you priced it properly, will no longer buy it. So you lose potential customers there. And also there's probably a lot of customers who perhaps would have upsold to a higher version had it been priced effectively, who will now be stuck in that middle version. So you haven't created a disaster, but you've lost a lot of potential by just forcing this Goldilocks approach rather than letting the chips fall to the right right packages. The third one here we call the Grand Canyon, and it means really having a lot of space between your packages. The best way I can describe this is to give an example. I once worked with a client who had 4 packages. The first package was priced at $15 per month. The next one was priced at $150 per month. The next one was priced at $1,500 per month. And the last one was priced at $15,000 per month. Now, one of the big benefits of packaging is to give customers a choice and allow them to select, right? And no customer is going to come in here and say, do I want the $15 a month version or do I want the $15,000 a month version, right? Those are going to be very, very different packages, and they're really tailored for completely different buyers, different sizes. So the right fix for that is you're having your packaging do too much in that situation. You're trying to differentiate across size of customer in addition to just giving features and functionality differentiators. You would be better off setting the price levels of those packages closer together and then allowing a price metric to scale the price up and down based on something that aligns to the willingness to pay. And then the last one here is too many sources of difference. I'm sure you are all very familiar with those classic SaaS pricing pages when you have your different packages, then you have a laundry list of features with check marks next to all of them to show what's included. Sometimes these lists can get incredibly long and you can get to 50 to hundreds of features. For a customer, that can get incredibly confusing. So I don't know what is important and what I should be focused on, then there's just too many things to look at as I'm crossing over from one package to the other one. It ends up muddling the choice and making them less likely to buy. You are far better for communicating your packages as just focusing on a couple of features or capabilities that are really A, aligned with the value that the customer gets, and B, aligns well with the philosophy of how you're gating and positioning your packages, and just letting them focus on that. It creates the whole thing a lot more seamless.
James, maybe we take there's a good question here coming from Hans. Good, better, what would you go for? A good, better, best type of packaging, or introduce just one basic plan and then charge for extras?
Like add-ons, I assume the extras would be something like that.
Question.
Well, we'll actually get into that in a little bit, actually. We can sort of talk about whether certain features and capabilities should really be part of premium packages or part of add-ons. So we will go and answer that that differently. But I would say, Hans, it's somewhat dependent on the amount of features and capabilities that you're working with and their profile, right? If you have, here's another. It depends. If you have enough features to be able to differentiate and actually create 3 compelling packages for different use cases or different situations, then I would say a good, better, best is better than having one base and having a lot of different individual add-ons. But not every product is going to have the breadth of capabilities yet to be able to do that. And also sometimes if these individual features are more niche, they're more things which some customers are going to want and some other customers aren't, then you're better monetizing them through that add-on structure than you would be through the tiers. Cool. Shall I keep moving on, Itai, or any more?
Let's go. Let's move on. And if there's questions, people should feel free to ask.
Yeah, exactly. And this is how you start the classic. You'd be able to answer some of these questions actually is through this analysis right here, which we would call a feature evaluation grid. So when you're thinking about how would I construct these tiers, well, how do I decide what goes in base versus premiums versus add-ons? The best way we have found to do that is to be able to go to your customers, do some light research, and just ask them to categorize these features for you. You have to explain the features so they understand what they're reacting to. But with each feature, go and ask them how valuable is each one of these features? Would you consider this particular feature something which is not valuable? Is it something which is kind of a nice to have? Is it something which is essential and you would consider it table stakes for any product in this space to have for it to be useful to you? Is it something which is differentiated, right? Which means this is something which, if it didn't come as standard within a product, I'd potentially be willing to pay more for in order to get it? Or is it something that's more than you need? Now, if you take that frame, there are two answers there that correspond to this is a valuable feature, and it's the this is a table stakes thing that I need to have, and it's the differentiated this is something I would pay more for. So in this chart here, everything falls into a 2x2 in consulting. The x-axis here is the percent of customers who find the feature valuable. And then the y-axis here is going to say, of those customers who thought it was valuable, what percentage of them said that they would pay more for it? So if you do the analysis that way, then the bottom right category here becomes your core features. These are things which lots of customers consider to be valuable, but not many of them would be willing to pay extra in order to get. So those are really the things that you would need to have within your base package to make it compelling. Now the top right, these are features which a lot of customers find valuable, and a lot of those who find it valuable would be willing to pay extra for. So features in that general area are going to be really great features to put into a higher tier, because lots of customers will want them together, and lots of customers will pay extra in order to get that. So that kind of makes it ideal for that better and best package that you could be constructing. Now the top left here, this is where we get to the add-ons. So anything top left, there's not that many customers who find them valuable, but those customers who do find them valuable would be willing to pay extra in order to get them. And for those features, if you put them into your tiering, you're going to end up having to discount them pretty heavily, because most customers aren't going to value them and aren't going to want to implicitly pay for those features. So you're actually better off in that situation to break them outside of your tiers, charge them appropriately based on the value that they're going to be providing to those few customers who do find them valuable, and allow them to just opt in or opt out. That's when those add-ons, those extras would come in, as Hans called it. And then the bottom left here is the final quadrant. We call this ancillary because they're features which people don't consider to be valuable and they wouldn't want to pay extra for. So oftentimes these can be features that, this is a new feature that you were betting on. This information might give you pause for thought and think about, maybe this is not worth the investment. If it's something you already have and is fundamental to what you do, it's just something you would stop talking about with the customers, right? They're there, they exist, but you don't want to muddy your value proposition messaging by telling the customers about these features, because they don't care about them.
James, a question here from my side on this niche category. So if you have this certain feature that not enough of the customers there's a certain segment of customers that are willing to pay for it. It's not a lot, and those who are willing to pay for it are willing to pay quite a bit. So how do you decide if this is an add-on, or maybe this is that last package on the right?
The right side.
Expensive?
Yeah, I think there's an analysis there, Itai, that says if you've got a few of those features when there's not that many people who want them, but they'd be willing to pay extra for, are the customers who want to pay extra for all these features the same customers, right? Like if it's a small segment of customers, it's only 20%, but it's the same 20% who value these features, then that means you could probably put it in as that premium tier, right? Knowing that particular 20% are always going to go up and buy that thing. If it's a different set of customers who value those three things, you'd be better off separating them out, because it's unlikely that the customers who are buying it are going to want to pay for everything there. They'd rather just pick one thing.
Makes sense.
Yep. All right, that is packaging. So I think let's move on and talk about price metrics here, the other component of price structure, which is really important. In my opinion, one of the most exciting aspects of SaaS and SaaS pricing really is the freedom now that we have to be able to pick our units of monetization. Back in the old software days, you were really constrained to licenses because you were installing them on individual desktops. And now we really do have the freedom to be able to price on pretty much anything as long as it makes sense, and we have the operational capabilities to do it. And it means now that there's almost an infinite number of options you could potentially charge based on. And so now we don't even keep like a log of these are all the different price metrics you could choose from. We tend to think about categories. So the categories we would consider would be user-based. So this is the one that's closest to that traditional seat or license-based model. Seats would be in there, active users would be in there, endpoints, devices, anything that kind of corresponds to how many people are actually using the product. And then there's usage-based, which is having a kind of a resurgence at the moment. There's a lot of usage-based pricing happening, and I think that has really gone along with the increased adoption of AI and just generally the value of products being more driven by how customers are using them rather than how many individual users are using them. But there you're thinking about things like API calls, number of tests, number of downloads, number of sessions, anything that really corresponds to the users, how they're using the product. Similar but different is capacity-based metrics. So these are usually, it's usage aligned, but it's usually placing a restriction on that. So giving access to a number of gigabytes of storage or RAM or a number of cores or something that you can put a constraint on, allow people to use up to that. The next one, business-based. This is actually one that gets forgotten about a lot in B2B pricing, but this is essentially saying for your price metric, pick a characteristic, a scalable characteristic of the companies that you are selling to. So it could be, maybe we'll set price for you based on your revenue, or set price for you based on your number of employees, or the number of customers, or the amount of spend within a particular area. Really, theoretically, anything is potentially up for grabs there that would correspond to the value that you are providing them. And then the last one here is very interesting, I think, because theoretically it is the best way of doing it, but practically you see it used very rarely, which is output based. And it's saying, I'm going to set price for you based on a metric which corresponds to how much output you actually get from my product. So if I have a product that ultimately is going to help you generate more revenues, I might set price for you based on how much revenue is actually generated. So theoretically, it's great because it's completely value aligned. It's very clear. Practically, it doesn't happen because there's complexities in setting that. If you are sort of increasing a particular metric, there's the question about how much are you doing versus how much is being done by other operations that may be happening within my business. So attribution can become a little bit difficult. You have to baseline it and measure performance above that, which can get complicated. And also, if you're a growing vendor, if you're going to be charging based on the output of something, that usually involves waiting a certain amount of time for that output to be realized, which means you need to delay your payment by a certain extent, which for many smaller growing companies is just not viable. And I think that's why I see this most frequently, usually in larger companies who are launching new product lines, and they have the capital to be able to wait to get the returns on that. Mm-hmm. Do you have a question in time?
Yeah. What do you see in the current economy with, is there a kind of a model that a lot of these models worked really well in the last decade when things were only up and to the right? Employee bases were growing, usage was growing. Now with companies kind of downsizing, shutting down projects or less employees, some of these models are also, hurting vendors. So is there like, how do you think about that component?
Yeah, absolutely. Yeah, so I think it sort of comes into the criteria you think for a metric, which we will get into on the next page, right? But I think it's it means sometimes when you're monetizing your product and you're picking a unit of monetization, it's really important you pick something which is generally going to be growth aligned, we call it, right? Something that is going to go up rather than go down. And I think in some industries where there's a lot of products that are based on headcounts and number of employees or number of seats and things, number of employees in economic downturns, companies tend to downsize. So immediately the size of that metric is going to drop. Also, number of seats. Usually seats is completely discretionary. I can choose to have as many or few as I want, so it makes it very easy for me to take them away. So generally in those situations with downturns, you see companies switching to things which are a little more stable in those periods, the things that are not kind of as susceptible to being changed by the pull of the economy. Either doing that or changing the architecture around their pricing so that maybe the number of units goes down, but maybe the price level reduction you get through decreasing that number of units isn't the same magnitude as the actual reduction. Sort of having banding and sliding scales can help with that.
Mm-hmm. Makes sense. And just to answer, I see Hans has a question more to me. Where does Duda fit in this? So I think for the grand majority of our customers, we are probably on the usage based, right? It's a per site per month or per site per year. I think in some cases to our more medium and bigger customers, there's also this aspect of a platform fee that comes with our custom plans, with a usage based on top. So with published sites on top of that platform fee.
Yeah.
Okay, let's continue.
Yeah. So then, given that we have so much choice here, there's a fair question of, well, how do we choose between all these different metrics? How do we pick something that's going to work for us? And the answer there is to consider the criteria of a good pricing metric. And the first one, and the most important of all of them, is the value alignment, right? Which basically means if a metric is value aligned, it means that the customer is going to agree that as this number of units of my metric increases, I get more value from your product. So we use seats as an example. Seats is value aligned if I think I get significant extra value by having one extra person be able to use the product, which is sometimes the case, and it is sometimes not the case. But if you can pick a value aligned metric, then you really get this virtuous cycle. It's self-reinforcing, right? You're telling people I'm charging based on this metric, and as this metric increases, you get more value. So there's a real alignment between your value proposition and your monetization, which is really the gold standard. Next criteria, we already mentioned this in passing, is growth oriented, right? In general, many companies of the size and scale we're talking about, it's very important for them to grow revenues, and a big part of that is often we want to be able to increase the revenues of each individual customer that we are selling to over time. So if that's the case, if you are monetizing on a particular metric and that metric generally tends to grow over time, then you're in a great position there, because you know that you've got a lever to be able to increase their revenues. I think it's really key to really challenge on this whether it is growth aligned, though, and make sure that it is growth aligned in all situations, because to Itai's question, right, sometimes these metrics do go down in periods of difficult time, and as we'll talk about in the case study a little bit later, sometimes these metrics just naturally go down and you wouldn't necessarily think about it because of the way that your product is evolving. There are other criteria as well. So acceptability, this is around fairness, right? It is quite possible, usage-based pricing gets into this sometimes, where the customer might agree that the metric is value aligned, but I still don't think it's fair that I should have to pay based on it. So you sometimes have those conflicts, and checking that it's fair checking that it's seen as fair will make a difference. Controllable and predictable are very similar, but controllable is, as a customer, can I kind of decide how many of these that I have and set a cap? Predictable is, if I'm being charged based on something, am I going to be able to predict the number of units that I'm going to need, and therefore am I going to be able to predict what my price is going to be? And again, if you've got something which is scaling all over the place and it's being used by people and I don't have any control over that, it's not very predictable, and I could be vulnerable to massive price increases that I've got no control over, and that can be a barrier to adoption for a lot of companies with strict budgets. And the last one is auditability, and this simply means, can I measure and track it objectively, right? Because if you can't, then you're really going to be reliant on the customer to tell you how many of this particular metric they want, and that means you've got to do the exploration and validation of that, which adds friction, but also it gives the customers an opportunity to lie and get a lower price point. I think that actually happens less than we would think about it, but it is a possibility. So these are all the things you want to think about when you're doing it. Let's talk about usage-based pricing a little bit as well, because as I say, that is a trend area. There are a lot of companies trying to do this right now, and there are many benefits of it, right? It's becoming more familiar to customers and more acceptable because of its prevalence. It is highly scalable. Usage can usually range from very low numbers to incredibly high numbers, so it allows you to kind of really get a good spread across all your customers, and assuming that does align with willingness to pay, you can definitely get to a lot of different price points for different customers. Usage metrics do tend to grow over time, as we've talked about. There are situations when they don't, but they do in general. If usage is correlated to value, then a lot of times usage will go up as customers start getting more and more value from the product. And also a lot of usage metrics, if you're cloud hosted, they will be they can be based on your costs in the clouds. Like a lot of the metrics that align with what Amazon Web Services and so forth will charge for. Therefore, if you're pricing based on that same metric, you know that you're covering your costs, which can be important to some of the customers where those costs are a large portion of their overall cost base. However, there are a lot of pitfalls as well, and I think these are not always so obvious from the outside looking in. Firstly, usage-based pricing is not always value aligned. It's not always the case that value increases as usage goes up. And even if it is, even if customers agree that in general, yes, as I use it more, I'm getting more value, they often will not agree that if I use it twice as much, I get twice as much value. There's going to be a diminishing return there. So if you're going to do it, you have to really think about how that value does change with usage and allow your pricing architecture to get to the right price points. It's not always growth oriented. As we said, there are situations when usage can drop off over time, which means you can be vulnerable to downsells. It can often not be predictable. So a lot of these usage metrics, particularly if they're kind of end consumer metrics. So if I'm a customer buying a product, if the usage is how my customers use my product, that's what I'm being charged on, I have absolutely no control and often no visibility into that at all. So I could be very vulnerable to massive price springs, and that could be tough. Oftentimes, usage-based pricing, in the way that we think about usage-based pricing, doesn't count as recurring revenue, and that's a key one, right? Because if you're pricing based on usage, you're recording usage and then charging for how much usage you had, that is not recurring revenue. It might be reoccurring revenue, but that's not going to have the same multiples. So that's a consideration as well. There are things you can do to fix it, which we'll talk about later, but it is something to think about. And lastly, usage-based transformations, if you do not have the infrastructure already to track and measure and do all the things you want to do with it, it can be a lot of effort to implement. I will bring up this one very quick case study here on picking a usage-based metric. I was working for a company that had a product that had intelligent search capability that you could plug into websites, e-commerce sites, etc., to be able to help you find what you're looking for. They wanted to move to usage-based pricing, and obviously the metric that jumps to mind is, well, number of searches, right? If I'm searching for things, I'm getting value, so let's charge based on number of searches. However, there was some complexity there because, firstly, a search is a keystroke in the technical back end of it. You see, when you go into Google and you start typing, if you're searching for bear, if you type B, it starts bringing up a list of options for B. When you type BE, it brings up another list of options. Each one of those is technically a search. So if we're just using our technical definition, that's not value-based because the customer wasn't searching for those individual components. They only want the final answer. There's also an issue that as their search algorithm improved, you might expect that they would need fewer searches or fewer iterations of the searches to find what they were looking for, right? You know that when you've gone into a search engine, you try something, you don't find what you want, so you try something slightly different. So again, as they got better of thinking about what customers are actually looking for, they might expect their number of searches to go down, which is not what they wanted. So many iterations and conversations later, we all ultimately stacked hand on a metric which is unique searches, which is basically a new metric that was created saying it is any searching within a certain time period, regardless of keystrokes or how many individual searches, that counts as one search. So if I'm there and I'm searching for about 2 minutes and then I stop, that would be one search session. And that is then a value aligned, and that will go up as people start to use the product more, so it controls for the things that we were trying to solve for. Final point here, think about your architecture around your metric. If you're trying to solve for acceptability and predictability, you can put caps in place to say that whatever your usage gets to, it's not going to be any higher than this. That can give some kind of certainty. You can put bands, so as long as you know roughly where you're going to be in terms of usage, your price level is not going to change. That can help with it as well. Or sliding scales, right? You start to rapidly decrease the amount that your price increases as you get up to higher levels of usage. So yes, your usage may get significantly higher, but you're not going to be paying that much more for it. All of that can help you manage that. And lastly, I would say controlling for this ARR thing, the real unlock here is to move from this kind of transactional usage-based pricing to more of a usage-based subscription, as it's generally being called, which basically means rather than charging in arrears for the amount of usage that you did, you will set a subscription price for a certain capacity of usage that you expect your customers to stay under, and charge them a flat price per month for that level of usage. Don't let them downsell within the term of their subscription. And at that point, it is recurring revenue because it's predictable. It happens. It doesn't change until renewal, just like a user-based subscription would. You can then still start making choices about whether, if they do exceed their usage within that period, do you start to charge them overages? Do you give them options to upsell to different tiers within that? You can build all of that into it. But I think that's really a way of getting the benefits of usage-based pricing and keeping the benefits of a more classic subscription. All right, that's all on price structure, and that was the biggest section. So let's quickly go through price levels and price execution here to give you those thoughts. Price levels, really helpful to think about price levels, right? I think it's usually, if you're thinking about changing your price levels, most of the time it's because you suspect your pricing might be too low, and there are a number of signs that could indicate that would be the case. Generally, if your customers are not complaining about your prices, or they're saying how great the value for money of your product is, good indication that you can increase your prices. Your customers shouldn't be delighted with your pricing; they should be content. So if you're hearing that, definitely suggest that you can increase. Not a guarantee, but if your churn didn't increase the last time that you put through a price increase, suggests that there may be headroom there. You have to be a little bit careful of that, because if you have a product where there's not an obvious alternative, customers might feel trapped. It might be the case that they feel forced to pay the price increase, but they're very unhappy about it, and they'll be looking for other options. So keeping an eye on customer satisfaction at the same time as looking at that is really important. If your win rate is really high, right? If you're kind of hearing, we never lose a deal on price, that probably means that you're discounting a bunch to be able to win the deals. Really, if you've got a good product and you are differentiated, you should be willing to walk away from a certain number of deals based on price, right? If they haven't got the willingness to pay for your product, you should let some of those customers go. If your sales reps aren't asking for discounts, you almost certainly can increase your prices. Salespeople are very quick to ask for discounts, as we'll talk about later. If they're not asking for it, you can probably increase. Also, just from a value-based perspective, if you feel that your competitors are weaker than you and they are charging the same prices as you, or you've got competitors who are about the same value as you who are charging more, then it almost certainly means that you can charge more, and should. Because if you keep pricing at the level you're pricing, then what's probably going to happen is everybody is going to decrease their prices, and you're going to end up having to decrease your prices again if you want to keep that same positioning, which just sucks value out of the market. So nobody wins in that scenario. So when you do find your prices are too low, then you obviously want to find out what your prices should be. So you look at techniques for getting to willingness to pay to try to help you understand that. And there's lots of different ways of doing this. I certainly won't go through all of them today, and they all have different pros and cons. I would say two that we'll focus on today are firstly the Van Westendorp technique, which I think is a really good way of just getting a good sense of the range of viable prices for specific customers, and it's quite easy to do that across a range of customer sizes as well. So we found it very useful for that, and also doing a value proposition map, which is very helpful if you're in a very competitive space and you want to be setting your price relative to your value differential versus your competition. So Van Westendorp technique, it's a research technique that really relies on the idea that there isn't like one specific price that works for a customer. There's a range of viable prices, and there's going to be different probability of them buying within that range. So rather than asking a respondent or customer, what would you pay for this particular product, you ask them to define 4 levels for you. Tell me what price you consider this to be inexpensive, good bargain. What price would you consider this to be getting expensive, but you still consider it? At what price would it be too expensive to even consider? And now also tell me, at what price would it be so cheap that you question the value that the product actually provides. If you can do that, you can think about different relative purchasing probabilities for prices that fall outside of these ranges for customers. So there's no chance of them buying it above too expensive or below so cheap. You probably maximize the chance of them buying it somewhere between inexpensive and getting it expensive. If you can do that, then looking across your entire customer segment, you can then start figuring out what price level do you maximize volume. You're going to have most customers buying it. At what price point are you going to maximize revenue? And if you're able to have your variable costs plugged into it as well, you can also extend that and say, at what price levels do you maximize profit? So this can be really helpful if you are trying to price to a specific business objective, right? If I'm really looking to maximize my profit here, I'm going to price at $490. If I'm at the moment, based on my evolution, I'm more interested in just building share, then I'm better off at pricing at $150. The next one here as well is the value proposition map or value profiling. And the idea here is to be able to understand the value differentiation of your product versus your competition and set pricing for that. So the way you do this is you tap into all the attributes of a company that a customer might be considering when they were making a vendor decision. So you might have things like, how easy to use is it? How broad is the functionality in this particular area? How good is the customer support, et cetera, et cetera. And you find out from them how relatively important are these attributes in your decision making, and how well do you perceive all the vendors that you have experience with to be performing on each one of these attributes. And then you also ask them, what is the relative price level of all of these vendors from all the quotes that you've received? So doing that, you end up with a map on the left-hand side, which we don't have time to go through in too much detail, but fundamentally it'll then tell you which of your attributes are competitive advantages for you because they're things that are really important and you're performing really well at, versus things that are really important that you're not performing well at and you should focus on. But all of this can give you a weighted average value score, which when you then combine with your relative price level, allows you to plot a graph like this on the right-hand side here, where you're the dark blue dot and all the light blue dots are your competitors, and you can see what your relative price to value situation is relative to them. In this particular case, this client they are perceived to provide a lot of value relative to the price level that they are providing. So there is a pricing opportunity to increase there. Do you have a case study here? I'm going to skip over it in the interest of time and make sure we finish up here, but we can go into price execution. Any questions on the price level piece before we go and quickly cover off price execution? All right.
Yeah, nothing on the chat, so we can continue and get to questions maybe towards the end.
Towards the end, perfect. All right, price execution then. So this is how you prevent discounting all your products away. I think the most important thing to realize here as you're going into this is that, in smaller growing SaaS firms, we like our sales teams to be very entrepreneurial. I mean, that's what we want them to do, go out and win business. We don't want to change that. That's exactly right, and they should be applauded for the ones who did that well. But you have to remember that if your sales team are compensated as a flat percentage of the ARR that they bring in, which they often are in these cases, then they are incentivized to discount as much as they possibly can. And that's kind of counterintuitive. The usual response to that is, well, but if they're incentivized based on ARR, if they sell at a higher price, they end up getting more compensation, so they are incentivized to do more. That is true, but it doesn't consider their perceived chance of winning at those different price points. A salesperson is not necessarily going to be running the math, but really they're thinking that their expected payout from every deal is going to be a function of their perceived chance of winning the deal at the price point they're charging, multiplied by their incentive payout if they win. So if you think how that translates to a no discount or 10% discount, the incentive they get if they discount 0% rather than 10 is about 10% higher. But usually, rightly or wrongly, often wrongly, in most cases, salespeople will think that their chance of winning at that higher price point just drops off a cliff. It's massively lower. So the function of those two things together means that your expected payout at either one of those price levels, it's significantly higher when you discount more. And that's why if you analyze the frequency of discount percentages across Salesforce, and I've literally done this probably about 30 times and got exactly the same result, you see charts that look like this. And these peaks here, there's lots of discounting at 10%, 25%, and 35% in this case. And that's because 10% is the maximum amount that a sales rep can discount on their own. 25% was the amount they could discount if their sales manager approved it. And then 35% in this case was sales director or could be C-level executive. So you can see they always default to going to the maximum level that they possibly can, which obviously is not great for you. You would much rather, if they can get away with pricing at 5%, you would much rather that they do that. And the way that we can do that, the way that we can stop them discounting more is through three levers. This firstly is rules. So this is basically putting constraints and stopping salespeople being able to discount more than you would want them to. So part of that can be the approval thresholds, but we've already shown that they aren't that effective on their own. Another thing that you can do is to institute rule-based discount levels. So you might say to a salesperson, you can discount up to 5% with absolutely no justification at all. It's fine. You can just do that as part of a negotiation with the customer to show that you have autonomy to make those decisions. But if you want to discount beyond that, there has to be a certain situation applying or a give-get, right? So it might be, if the customer is in a particular segment, which is strategic priority for you, you can give a 3% discount for that. Or if they sign up for a 2-year deal as opposed to a 1-year deal, you can give 5% for that. Sometimes you can get quite creative with this and start thinking about, well, what about if they give me, 5 warm leads to people who are within my target buyer profile that I can send to? That might be worth an extra discount as well. But in all those cases, you're either aligning it to a situation that corresponds to either something that you want to incentivize, or something that corresponds to a lower willingness to pay, or something that is just trading price for value. So in that case, you're moving from a situation when you're just giving up price for the hell of it to far more strategic discounting, which is absolutely fine. You can also think about incentives as well. How do you incentivize salespeople? You can kind of make them more incentivized beyond just that 10% increase we talked about to price at higher levels. So the obvious way of doing that, but is often a bit more complicated than we typically want to go to here, is obviously you can incentivize people directly based on their adherence to pricing levels. You can give them incentives based on their discount percentage or based on their average price level. Tends to be a little clunky for growing companies, honestly. So you think about the other things that you can do that are easier to do that will have similar effects, like potentially you keep your incentive scheme based on ARR, but then you'll have a kicker to the bonus percentage at the end of the year based on your average discount level that they achieved within that period. Or sometimes I've seen it be effective just simply publishing a ranked lead table of all the sales reps based on their average discount percentages. They may not care about being at the top of that list, but they definitely don't want to be at the bottom. So it it can create more of a healthy competition to push them to discount less than they would otherwise do so. Then the last one, which gets forgotten about, is enablers, and this is basically solving for that perceived chance of winning at those price levels. So you want to be able to make sales reps feel more able to win at higher price points. To do that, that can be partially sharing information. So if you have done research on customer willingness to pay or research on your value differentiation versus competitors, share it. Don't just give them the outputs of it and say we should be pricing higher. Show them the data that shows that you are better or that customers will pay more. They will believe it more and they will feel better about fighting for those higher price points. Giving them value messaging that will help them defend those higher price points. So they're not reliant on doing it on their own. And of course, training them on doing value negotiations and being able to defend price within those conversations. That will make them feel more able to win at those higher price points as well. All right, I think we just got through it in just about the right amount of time, but summary here, I think 3 things to think about. So firstly, building an effective price structure. Think about your good, better, best packaging, how to build it effectively, pick the right price metric, set price levels using a technique that's going to help you get a good pulse on willingness to pay and what you should be able to charge. And then to stop your discounting, consider rules, incentives, and enablers.
Awesome. James, this has been super interesting, and obviously you have a ton of experience here. So I know we're at the end of the hour, but I'll ask a couple of questions, and whoever can stay can stay. Folks who want to come back afterwards and see the recording, you will all get a link to this session. So James, kind of one of the things is, right, we obviously are, as platforms, solutions, we're trying to constantly optimize, and many times we have a lot of different features and different pricing mechanisms and different tiers, and it starts getting pretty complex.
Yep.
You look at definitely, I think over the years, Duda's pricing has become more detailed and more complex. I look at some very established vendors in the space like Salesforce or HubSpot. You'd go to their pricing page. It's you need a PhD to really understand how they price it, because they're trying to optimize for every single feature and every use case.
Yep.
So what's kind of your sense there? Are like, should we stay away from, like, do we bear the risk of over optimizing our pricing and becoming too difficult, or are people who are really interested in our products going to take their time and to really understand it at a very granular level?
Gotcha. That's a great question. Can I get another big "it depends" flag? But it does, honestly, like, so that I'll give you a bit more information there, right? So it does depend. It depends on different factors, right? I would say it depends on your objectives. Yeah. And it depends on the segment that you are selling to, right? So if you're selling to consumers or an SMB buyer, right, you're usually selling to somebody who's not a purchasing specialist and who's probably strapped for time, doesn't have time or the energy to go and evaluate lots of different things. So for that kind of buyer, if you are building a pricing strategy which is incredibly complex and multifaceted, then you're going to lose them. It's going to make them far more difficult for them to make a decision. So you generally want to avoid more complicated structures in that situation. Likewise, right, if it's a lower price product and you're maybe doing, you're not having a sales rep involved, it's a short sales cycle, people could buy directly over the website, for example, that times 2, the same situation. You want to make it very easy to understand, quick to make a decision, and so forth. However, and the last thing on that is objectives, right? Also, I'd say if a big part of what you're trying to achieve as a company is to bring on a lot of customers quickly, then a more complicated pricing strategy is going to increase the length of time needed to make that decision and understand. So you're going to decrease your sales velocity. So again, then you'd want to move to something a bit more simple. However, like the opposite situations which do occur would push you more towards something that's a bit more complicated, right? If your objectives now, you're more mature, you're thinking far more about optimizing revenue or optimizing profitability. In that case, you generally do want to have a more complicated pricing structure where you have more options and more things, because the way you're going to maximize your revenue and your profitability for all your individual customers is, being quite granular in how you charge them for all the different things that they might want. So providing the juice is going to be worth the squeeze there, you would want to have all of those extra decisions. Also, you're selling to larger companies and enterprises. You're usually dealing with a procurement person who will have the time and the patience to go through everything else and probably wants to actually select from, lots of different things and get a far more customized plan. So they'd actually prefer that than have something which was super simple, where they didn't get that same level of control.
Absolutely. I think, I kind of think about it as, pricing is just the same as you're marketing your product. You want people to get like the basic information at a glance, and depending where they are in the buyer journey, as they're willing to dig in and spend more time with your product, you want to get more granular and more detailed understanding of the pricing. And I think this is why, you can see it on Duda's pricing page. You can see it on a lot of other platforms. There's kind of this pricing view at a glance that you can get kind of the main gist of how it's priced. And then just below that, there's kind of a much more expensive detailed table that breaks down the more granular features that might not be relevant for everyone, or for, again, someone who's more willing to spend time to understand.
Absolutely. Yeah, exactly. And I totally agree with that. I think even when you do have something more complex, you need to be able to summarize it at a high level still relatively quickly. Right? I remember building a pricing strategy for it was a market research platform which had a lot of services as well, and there was a ton of different components here because there's so many different offerings. But we had to be able to boil it down to, first you pick your tier of your platform, then you pick your usage tokens, and then you choose your services. So like that message is relatively simple. Okay, I get it. But then they go in and they get all the complexity and the details within each one of those individual phases.
Awesome. What do you think about A/B testing pricing? Is that something that you're in favor? Is that something you recommend to customers? I know in some cases it's difficult to A/B test, either because there's not enough volume to get statistical significance, or it could take a very long time to get conclusive answers, or maybe it's just like very hard to test pricing because your customers might see different prices and things like that.
Yeah, absolutely. No, I am in favor of A/B testing in certain situations for specific things, right? I think A/B testing is really great if you've generally got your pricing strategy figured out and you just want to optimize the price level within small variation, or maybe you just you're unsure about whether this particular feature goes in the middle package or the top package. Like for a very simple thing like that, A/B testing is great. You're going to be able to get a good answer from that relatively quickly. So long as you're in a business where you have enough kind of volume that you can get answers and get enough results to be able to draw a conclusion from that without having burned a lot of your actual demand through doing that experiment. Assuming you're in that situation, I think it's great. Where I think it's sometimes misused is like A/B testing is not a good approach to build an entire pricing strategy from scratch, because you can only test what you test. And usually, as we've talked about today, there are so many different options that you can explore across your, the packaging styles and how you build them and the metrics and everything else. You can't test enough stuff through A/B testing that you would be able to get to the answer. And if you did, it's kind of like the Heisenberg uncertainty principle, right? Like you can't measure anything without affecting it. Like every customer who comes and looks at your pricing when you've done these different experiments is going to be influenced by that. So you end up kind of affecting a lot of your potential customer base through doing it. So you're really better off, I think, doing research up front to get the answer directionally right, and then use A/B testing if appropriate to just take it from 95% to 100%.
Makes sense. Looks like we have a question here from Hans. Will you overprice a corporate product just to show it's not cheap, as cheap products look not good for a corporate client?
Yeah, so would you, I would say overpriced, but definitely, I mean, I've seen case studies where a client essentially was charging for a product, not getting much traction in the enterprise segment, and it was because they were pricing not enough for it. People assumed it was not going to be good because it was priced too low. And that's really, I mean, the Van Westendorp technique we talked about earlier, right? We have that too cheap level. That's really what it is. It's like if it's going to be that low, I just can't believe that it's any good, so I'm going to discount it. So I don't know that that's overpricing. I think it's just it's setting a fair price for the value that your product does. If you are perceived, if you are in that sort of too cheap category, it's not that you'd be overpricing it by raising it. It's just that you're severely underpricing it right now.
Yeah. I know one of the challenges that could be for companies that have different customer types, let's say they're servicing both SMBs and enterprises. If you display those prices on the website, typically for the SMBs at volume, you may be impeding how much you could actually charge from a corporate client or an enterprise client that typically would, you would also need to put much more efforts around servicing. So any thoughts of that? What have you seen some of your customers do when they have this kind of disparity between size and willingness to pay by different types of customers?
Yeah, I think the most common approach to that, and I think it is best, because you are in the situation where you don't want to give the enterprise clients your pricing because you want to speak to them, you want to learn what their willingness to pay is, and you want to give them something quite custom. But for a lot of the SMB clients, I've done research that says that 75% of SMBs say that they would not even consider speaking to a vendor if they didn't display their price on their website, right? So there's quite a lot of times when they would expect that transparency. And usually the way that I see companies get around it is when they show their packages on their website, they might have 1 or 2 or 3 packages that are tailored towards SMBs, and there they are transparent with their price. They'll put what it is, and then they'll have another package which is more tailored towards enterprises, which has all the features that the enterprises might be interested in. And there's basically where there should be a price, there is a contact us here, and you reach out and you go into that process. So as long as you do have to make it clear that those packages that you have tailored to SMBs are not going to be appropriate for the enterprises. So sometimes that means putting a capacity constraint or a cap on the number of users or usage or whatever it is. But as long as you can do that, that shouldn't poison your enterprise customers while still giving the transparency that your SMB customers need.
Perfect. So last question from my side. What's your opinion on promotional discounting where kind of all customers get the same discount? For example, we just went through Black Friday, so 50% off on all products. What do you think about that?
Yeah, I think it can be really effective, right? In different markets. I think it's very easy to overdo it. I think it's if you over promote, I think your customers learn that promotions are going to come across quite frequently, right? And it means that they're just going to wait around until a promotion comes and then they're going to buy it. Really, I think where that strategy came from, right? It's more of a retail thing that has kind of translated into SaaS and tech. It's a method of price differentiation based on the urgency of the purchase, right? Like you get to your most price sensitive customers by only giving them this lower price at this certain time, which is probably a long time away. So if they're willing to wait for this entire time to get that deal, they can buy it then. And I think that works as long as the promotions are infrequent enough that somebody who really is willing to pay more is not going to want to wait the 6 months to get that lower price. They would rather just buy it now.
That's great. James, we can be talking on and on. There's so much. This topic of pricing is so critical, and there's lots of things that we could be talking about. But given a time, we're going to wrap up. How can people reach you if they have any questions? What's the best way?
Yeah, absolutely. There's actually, we can pop my slide back up again. There's an email address. It's james.wilton@monovate.com. And actually, hold on. Let me get onto the page. Oops. There you go.
Perfect. Awesome. So thanks, James. And thank you, everybody who's been on the session. Hope you found it informative. And we'll be in touch. Thank you.
Fantastic. Thanks for having me.
Thanks, James.
Bye.